In the United States, an average person in their late 20s has about $10,000 set aside for retirement. How much dividend income could you expect from a portfolio of that size? While $10,000 will not be enough to sustain a conventional retirement, you might be amazed at how much it will pay in dividends. It can be enough to augment your income or cover the cost of a holiday. Examine the many scenarios that would result in various levels of revenue. This will give you an idea of how much money you'll need to become financially self-sufficient. Keep watching till the end to discover about a common misstep made by investors and how you may maximize your investments to make significantly more money in the future. We're Fortune Fastlane, and we've been assisting people in learning about money, personal finance, and investment. If you want to improve your financial future, subscribe to the channel and hit the like button if you found this video useful. There are a variety of dividend-paying investment alternatives available. The S&P 500 Index. The S&P 500 Index is perhaps the most popular investment. This is so popular because it gives you access to 500 significant U.S. corporations with a track record of profitability and stability. It's also well-adjusted, which means you own a piece of each of the stock market sectors and industries. Warren Buffett recommends the S&P 500 because of its long track record of positive returns. When investors say the market, they are most often referring to this. If you invest in an ETF or index fund that tracks the S&P 500, you'll get a dividend yield of less than 1.5%. Because many of the largest holdings are technology businesses, which are infamous for paying little to no dividends, this is the scenario. With a $10,000 investment, this index would only return $150 per year in dividends, or $12.50 per month. Dow Jones Industrial Average. The Dow Jones Industrial Average, or the Dow, is another popular investment. Another stock market index that investors refer to as the market is this one. The Dow Jones Industrial Average is made up of 30 of the major U.S. firms and is used as a secondary measure of how the U.S. economy is doing. Investors who buy a fund that tracks the Dow will get a dividend that is somewhat higher than the S&P 500. At just over 1.5%. Investing in a fund that focuses on producing higher income and less capital appreciation would result in a higher dividend yield. Many high-quality options hold equities of reliable corporations with a lengthy history of dividend payments. Invesco S&P 500. Consider the Invesco S&P 500 ETF, which pays a large dividend and has a low volatility. This results in a dividend yield of roughly 4%, which is much greater than the S&P 500 as a whole. It only owns the companies in the S&P 500 that pay the highest dividends, rather than all of them. As a result, long-term growth is expected to be significantly low. The annual dividend income from $10,000 invested in this fund would be roughly $400 or $33 per month. There are a slew of other high dividend ETFs available to senior investors. The fact that these funds tend to provide more stability is one of the reasons why they are popular among the elderly. They prosper in bear markets and fail in bull markets. It's no surprise that these are popular among retirees because of their steadiness and consistent income. Selecting a sector or industry-specific fund is a second technique to generate higher than average dividends. A fund like this solely invests in companies that are part of a specific sector or industry, such as energy, real estate, or healthcare. Because of the nature of their business, certain sectors pay bigger dividends than others. Because many investors are scared away by the volatility caused by economic changes, renewable replacements, and regulations, the energy sector is priced low and has a high dividend yield. The Vanguard Energy ETF. Consider the Vanguard Energy ETF, which offers a dividend yield of nearly 3%. Real estate investment trusts are also considered slightly hazardous, and they return the majority of their income to shareholders in the form of dividends due to their corporate structure. The Vanguard Real Estate ETF provides a yield of more than 3%. Investors who are prepared to do some study and purchase sectors that have gone out of favor can earn a lot of money. As the sectors return to favor, the returns will be in the form of dividends and capital appreciation. An investment of $10,000 in Vanguard's real estate or energy ETF would yield roughly $300 per year or $25 per month in income. Individual stocks are also a viable choice. If you're a newbie investor with a small portfolio, many finance gurus advocate investing in index funds or exchange-traded funds, ETFs. This manner, you may gain insight into market behavior, make consistent returns, and expand your portfolio without taking unnecessary risks. If you're willing to do the homework and take the risk, you might eventually opt to pick individual stocks. If you do decide to buy individual stocks, you should seek for a company with a history of dividend growth. The list of dividend aristocrats, for example, is a smart place to start because each aristocrat has a 25-year history of increasing its dividend. AbbVie, a dividend aristocrat, currently pays a 4.5% dividend. If you put $10,000 into this company, you'll get around $450 in dividends per year or $37 per month. Depending on future stock movement, you would also receive any capital appreciation or depreciation. Furthermore, it's a good idea to evaluate such prospects based on their foundations. Check for fair payout ratios of 50 to 60% or less, positive earnings, and a variety of other possible criteria. Individual stocks offer opportunities for bargains because they are frequently sold off, whether as a result of recent bad news, an earnings fiasco, or new management. Because the stock market has a tendency to overreact, this could be an opportunity. A knowledgeable investor must judge the gravity of such news and make their own conclusion about the stock price. Because most investors with $10,000 are still a long way from retirement, they should carefully consider foregoing dividends. Why? Because growth stocks have the potential to make you a lot more money in the long run. Dividend-paying assets have historically provided lower overall returns, so individuals who are still young should benefit. Over the course of a career, a 2% variation in yearly rate of return can make a tremendous impact. For example, someone who invests $10,000 at the age of 25 and receives an 8% rate of return until the age of 65 will have $217,000 in their account. They would have $452,000 or more than double the money by the age of 65 if they had earned a 10% rate of return. It's crucial to remember that growth stocks might be more volatile, which can be challenging for investors who aren't used to dealing with market changes. An ETF such as Vanguard's Growth ETF or VUG is a terrific option for younger investors. As the name implies, it invests in large cap growth firms like Apple, Amazon, Home Depot, and other well-known names. A growth index will certainly surpass the S&P 500 in the long run, which is great for someone who has a long time before they require income. Because majority of the stocks pay little or no dividend, VUG's dividend yield is less than 0.5%. Instead, they reinvest the earnings back into the company, allowing it to continue to grow at a rapid pace. Due to the low yield, a $10,000 investment would only yield roughly $4 per month in dividends or less than $50 per year. There are many high-quality alternatives to this fund that have consistently outperformed the broader market. People grow fixated on dividend yield and select investments that are inappropriate for their time horizon. In general, an investor with a $10,000 portfolio would be better off concentrating on growth and rejecting dividends totally. How much of a difference will $50 per year versus $400 per year make in your life? When it comes to paying bills and funding your daily needs, that sum is unlikely to be significant. When you're getting ready to retire, growth stocks will give you with additional money. If it makes sense, you can move your growth investments to income investments at that point. but don't make the error of relying solely on dividend yield at this stage. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you like our delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.